Hi, CF Liu here. Now today I want to give you a lesson on what is the P.R.R.R method in property investing. Now it's called P.R.R.R method, if you may, P.R.R.R method in property investing. And knowing this really the good method is a way for you to don't have to worry about the down cycle in any property market if you practice this P.R.R.R method. And the second thing is that you will outdo all your peers and all other investors out there if you know how to really harness the strength of this P.R.R.R method. Now, with that being said, let's get started right away. Now, the first P in this method is what I mean by purchase. Now, it might seem like a no-brainer, but just stay on me and then the entire sequence of process will be very clear to you. Now, first is of course purchase, which is for a lot of people like duh, right? Thank you CF for being Captain Obvious. But here's the thing, the initial conditions are super crucial. And what do I mean by that? Now you see that there are two ways you want to play this property market when you are in the purchase stage. Is that it's very important for you to get a property that is below market value, at least by like 20%. So if you want to play that in a primary market, right? Primary market meaning you buy your real estate property directly from developer. So how do we do that, right? How do we do that is that you must be sure that whatever price that you are buying from property developer, you survey the area surrounding for a similar unit or similar type of property. Now this is very, very crucial in property investing because this will actually determine in the long term whether you make money or lose money. Now that being said, if you know that the price is already being priced higher, right, then what is in the surrounding area for a similar unit like yours, then you know that your unit is overpriced when you buy that from property developer. And furthermore, when they have the cash rebate and all that, bear in mind that this is not free money. When you have like cash rebate, you need to know after the cash rebate is the selling price has a wide pricing gap between what is the pricing of a similar real estate property in the surrounding area, which is ideally below 5 years old. So meaning that is a new property, so you can get a more or less an apple to apple comparison. If you buy it over value from property developer, that is where you will never ever make money in your property investing journey. Now the second thing is to play this below market value, of course, is to play in the sub-sale market, meaning that you buy a property which is already tenanted. Ideally you buy it from another seller. Alright, so that is one way also, for whatever reason the seller want to sell even with a tenant, which is very rare actually. But the second thing is you want to buy from desperate seller. What is a desperate seller? Desperate seller who are people, let's say they are going into a divorce, right? So and then the property has two names attached to it, they're divorcing, so no matter what they need to actually liquidate that property so that it could be easily divisible between the husband and the wife, right? Or someone who go into, like they say need to sell it fast because you need to raise your money for medical emergency for their business. Now I know that this is not a situation that you want to take advantage of, but here's the fact: when you want to buy a below market value real estate property, you need to go to the sub-sale market, and to really get a good deal you need to find a desperate seller. Okay, that is just a fact or matter of life. Now the second R in the P.R.R.R method in property investing is what is very obvious, is called renting it out. No, I'm just kidding. How can you buy and rent it out? It doesn't make sense. That is why a lot of people actually fall into this trap. They buy and then they think that it's just rent it away. No, the second R in this P.R.R.R method is what I call is renovate or repair, right? Of course, if you buy in a primary market, you probably don't need to repair, but you still need to renovate because it's a bare unit. However, if it is a subsale unit, then repair and probably some renovation is required. And why is this so important, right? It's so important. I'm going to get into that. But a lot of people say that I want to spend the minimum amount of money to renovate my unit, because that is what we call the sunk cost. That is a sunk cost that you cannot recover whether it's worth it or not. Now let me put it into perspective. Now, just for a business, every business is run, right? People just got it backwards. When you really want to make money, you need money to make money, right? There's no free lunch in the world. People thought that a lot of things in this world we can use free money. Actually, it's not free. Even you use a method like loan compression, multiple loan submission to actually buy a lot of real estate property. That is still bank's money. It's not your money, which you ultimately have to pay back. So this sunk cost, right? The sunk cost in terms of repair or renovation cost, you need to understand. You need to say that what are the amount of sunk costs that is reasonable. You don't want to spend too much. You also don't want to spend too little, because this renovation and repair cost, which is a sunk cost, you know that it's very important for you to do, because it will increase your property valuation, especially if your property that you buy for property investing is an old unit and all that. So let's say if you spend 20,000 to renovate, and then because of that, after 2 years your property value actually goes up by 50,000, then that is a worthy investment. That is a sunk cost that can be recoverable. Now the second thing, of course, is the renovation and repair is needed so that you can command a higher rental rate, right? So again, this is what a lot of people don't see, because they thought that rental rate, okay, they cannot see this because rental rate is something that they have yet to actually accrue or get. But sunk cost is a big lump sum amount that you need to fall out upfront. That's why people are very reluctant. And I can guarantee you that is not how advanced veteran property investors do. They will always have a calculated this sunk cost. Does it increase my property valuation? Yes. Will it potentially increase my rental rate? Yes. And then of course the other thing is to increase your rentability. Now imagine that every of your competitor is bare units, but because you put in some money to actually renovate the property, it will be more appealing for potential tenant, because today is a tenant's market, right? It's very competitive out there. Tenants they are spoiled for choices. So you want to have this kind of advantage over other landlords, and that is why this is something you need to take care. Now the third R in P.R.R.R. method in property investing, of course, is what we call as a rent. Now a lot of people thought that it's just about renting it out, assigning that to an agent and all that, but there's an art and science of actually this what we call as a rental cash flow. And let me explain what I meant by that. Now the thing is, rental cash flow, how much you get is a factor of all these 5 elements. Okay, let's just start with income, right? Now if you have an income, right, if you have a high income, meaning that hopefully you have a higher saving, which can be used as a startup capital, 10 or 20% to be used as a down payment when you want to buy a real estate property to invest. So when you pay up a higher amount of down payment, you know that your age comes into place, because whatever down payment that you pay, maybe 10, 20%, 30%, end of the day you still need to take a loan. That is why we say property investing is about using leverage. And when you actually use leverage, right, you take a loan duration, you know that there's a certain loan duration you need to pay back, right? The older you get, the shorter is the loan duration. So that is why you have this age factor over here, and then it impacts your loan duration. So when it say the loan duration, the longer the loan duration, the lower is your monthly installment, your loan repayment. That's right, follow? However, if your loan duration is short for everything other thing being the same, you know that your mortgage duration is short. That contributes to a higher monthly repayment, which is why this is more like a chicken and egg, a catch-22 kind of situation. Because when you have a high income, just stay with me on this, right? When you have a high income, right, and that normally happens when you are 40, you are at the peak earning power, so hopefully you can actually pay a larger sum of the down payment, which is like 30% or something like that. And then, but you know that when you are 40, your loan duration will be very short, right? Will be shorter, maybe 20-25 years. That is where by paying a higher down payment, ideally it will lower your monthly repayment. And why there is loan repayment when you are low, mortgage repayment which is low, is it low repayment? That means that you can still have a positive rental income from your property investment. Just imagine, right? Just imagine if your monthly repayment is high. Of course, there are other factors like you take a huge loan, then your monthly repayment also high. You have a loan with a higher interest rate, then your monthly repayment also high. But these are the factors we cannot control. The one that you can control is how much repayment, how much down payment that you are putting in, so it reduces your monthly repayment. So it means that your monthly rental income would be either break even at minimum, or it's a positive rental cash flow. Now just imagine, compared to someone that have probably someone who are in their mid 20, and then their income is not as high, so they are forced to actually only pay like 10%, right, of down payment. However, you know that they have a long duration, maybe 35 years of loan, right? However, because they actually pay a very low down payment, you know that what is going to happen, that their monthly repayment will be relatively high. And when you have a high monthly repayment, you really don't see that kind of rental income that is coming in, and you feel like your property is not going nowhere, right? It's going nowhere. Now, all of this combined together, and you know that on top of all of this, you also have to manage your tenant. Right? So the thing is, a lot of people thought property investing is a passive income, it is a hands-free kind of thing. But no, according to the expert, and this is what I actually agree, right? Being a landlord nowadays is a full-time job, right? Being a landlord it's not a part-time job, right? A lot of people have a full-time job. They try to get into property investing like half-hearted, and they thought it's passive. That no, right? Do landlords still grow rich in the sleep? Yet no. Unless they work very hard, unless they work very hard during the day, right? Tenancy management and all that, get your units tenanted, get the best tenant. It is a full-time job, which is why you say that, well, there's a lot of trouble, you know, it's not as passive as I think. Now, that is exactly right. Right? So this is the thing that you need to expect. If you really want to be the best in property investing, it is a full-time job. And of course, the other R in this method, P.R.R.R. method, is what I call is rolling your finger to the like button and hit on the like button. No, seriously, I really appreciate that if you hit on the like button, if this lesson has been useful. Now, that being said, jump back right into here. The second last R is what we call as a refinance. Right? So this is why it is so important. When you refinance, there are actually 4 interacting factors when it comes to refinancing. Now, what are the criteria? CF is not my name, although it's the initial of my name. CF, your cash flow. If you see that we have talked about, you must have a positive rental cash flow. If you have a negative rental cash flow, that is going to affect your ability from being able to refinance your property. And the very fact that you can refinance your property is also because your property has already appreciated in value. Okay, but with the slowing rate of appreciation, you have a better chances to actually say that refinance and cash out from the increased valuation of your property if you already have bought it below market value. You get what I mean? Right? If you buy it below market value, then there's very high chance for you to be actually able to refinance as soon as possible. Maybe in the next in 3 years time, after your initial mortgage loan already passed or expire, when it comes to its lock-in period, there's no penalty anymore. You can refinance it in 3 years time, right? But likely not below 3 years time. So when you have increased valuation, we call that a positive equity. You can cash out the difference between your outstanding loan amount, if you are talking about in the first 3 years, the outstanding principal loan amount is not going to have reduced much because of how amortization table works, right? However, you know that with an increase in property value and some more furthermore it was helped by your buying that below market value, that makes it way easier for you to refinance that and cash out that kind of amount and use this amount to again buy another property for investment if you may. Now, but there is another two equation into this that will affect whether you are going to you can refinance it and the amount you want and the number of years you want. Well, all that is that you must have a good credit history, right? You must have a good history, meaning that your credit card repayment, your loan repayment, other loan, car loan, and all that, it must have you have a good repayment history. Now imagine if you miss your payment, although you can pay but you just forgot, you accidentally miss your payment, that is where your credit history, your credit rating will actually go down. You want to refinance for another loan, that is where you will find a lot of difficulty. And even with this good credit rating or credit history, you know that the next thing that you need to manage is what we call a DSR. It's called debt service ratio. Debt service ratio is basically what we call as your total net income. Okay, your total net income. Okay, let me put it another way. It's your total loan repayment, your car loan, personal loan, or whatever credit card loan, and also including your mortgage repayment, which is your house loan. You actually have to sum all of that divided by your total net income, and that is your debt service ratio, right? And normally we would say that if it exceeds 60%, 70%, 80%, that is where you are not able to get additional loan, okay, for to invest more in property, even though you can afford to actually pay the down payment because you got money from your savings, you pay the down payment from your savings in property investing, or either you kickstart your property investing ball rolling by actually cashing out and refinance, because that can be used to actually cover, right, for the down payment of your next property for investment. However, the thing is you still need to take a loan, right? What happens is if your previous property is already cash flow negative, right, it will actually affect your capability to actually refinance. Because let's put it that way, your debt service ratio, right, your debt service ratio, by taking additional loan, right, to invest in a property, that monthly repayment will only increase your debt service ratio if you do not have sufficient rental income to at least break even your mortgage repayment. Okay, so let me repeat that again. Only if you do not have enough positive rental income to actually cover your mortgage or house loan repayment, that is where it will actually impact or lower or actually increase your debt service ratio. Debt service ratio is something that you cannot exceed. There's a maximum cap. You exceed a certain percentage, that is where you cannot take loan anymore. No banks want to lend money to you anymore. That is how you cannot borrow money anymore. So this debt service ratio is super important. Imagine if you have at least that's why it's so important to have a positive rental cash flow, which is what I highlighted over there. A positive cash flow rental income. That means that it will not only keep your debt service ratio under check, if you even push down your debt service ratio, that makes you more eligible, can be more qualified for the next loan to buy another property and another property and another property, and this is how the thing will actually rolls, right? So these three things, very important, very, very super important. Now, so next, moving on, is the last R in the P.R.R.R. method, is to say rinse and repeat. This is a no-brainer, rinse and repeat. So just do whatever it works. Now the difficult part is not about the entire project. The difficult part is about finding undervalued property, having the money, the financial strength to renovate it so they can rent it out, have a higher valuation, and then rent it out to a very good tenant, very sustainable rental income. And that is how you roll one and another. And the final thing is, this is the most overlooked thing when it comes to property investing, is to say focus, because let's put it that way, property investing is not a part-time job. It's not something you do in part-time, in your spare time. It is a full-time job. You really want to excel into it, you really need to focus using the entire process that I share with you, and that already take your full entire day, right, or entire week or entire month. A lot of people fail. It's not because they are dumb, they are not smart, they are stupid, they are lazy. I mean, yes, they are lazy. It's because the thing is, you only have Saturday and Sunday. You're not working day to actually manage your property investment, right? So you don't want that. You really want to excel into this. You have to focus. You have to put a lot of time into that. Maybe become a real estate agent yourself, and maybe you just go full time on that. But if you have a busy full-time job or business, it's unlikely you can actually execute that. That's why a lot of people comment they cannot make money, is because they are not focused. You see, when we are focused, there's so many things in the world that can make money, including playing video games. You can see screenshot over here. These people who are not even 30 years old, they are making 25,000 USD per hour playing video game and streaming that, broadcasting that for the world to see, right? You can read more. This is not fake news, right? People are making $500,000, right? For example, this guy called Thailand Ninja Black, they are making $500,000 USD, 500,000 USD 1 year, just streaming, or even 1 year, or even 1 month, to actually broadcast 12 hours a day playing video game for other people to see. Right, so that is it. That is all I have for you today. Now, if you really like this lesson, you really find that useful, just click on the like button. I really appreciate that. Comments with if you find this useful, and let me know whatever question that you have down below. Click on subscribe if you haven't do that already. Now, the last thing I have for you is basically what are these small circles in over here. Now, I want to show you that this method, the entire P.R.R.R. method, it requires every of these elements to work together. That is why it's linked to each other. If you break any of these elements into this cycle, that is where everything crumbles down. So then there is this small little circle that's attached to every one of these. Is because there are things or factor or external factor that we cannot control when it comes to property investing during the purchase, renting, refinancing, and renovation, and even even on the repeating the entire process. So if we want me to cover that, like how to mitigate this uncertainty in property investing and all that. So just let me know in the comments below and say that I want CF, thank you, and I want you to cover for that. Now, that being said, this CF Liu, and hope you find this useful. I'll see you in the next lesson.